Michael Burry, one of the greatest investors around, is starting to buy. In this video, we're going to talk about some of his latest portfolio additions. What do I think about them? And this is very interesting. I view Michael Burry as one of the greatest investors around. You know, he not only called out the demise or the implosion of the ARK, innovation funds down 70 to 80% since he called that out, and I did a video on it, then he called out the great financial crisis where he made a boatload on these subprime derivative contracts. Then he called out the dot-com implosion, back to 1999, 2000, where he made a boatload on deep value stocks. So he has a successful track record here. Now, a lot of folks would like to poop on him and say, hey, he's this Cassandra, so he's always predicting doom and gloom. I personally view as the thesis that he's considered really hasn't changed. It's just the facts sort of get tweaked based on sort of emergency reactions by policymakers, such as the Federal Reserve. His concerns last decade, really, you had radical intervention by the central bankers. I mean, look at how much money has been printed. So it's very possible that the underlying thesis that he has, and I look at the debt and I look at the concerns that he's called out, I don't think it's really fundamentally changed. Like, I still think that the U.S. government is effectively broke. I mean, look at the amount of debt, look at the interest rates. It's going to be like, okay, there's going to have to be some money printing in the future. I mean, that's sort of the reality of the situation. Anyway, that's a separate topic. Let's focus on what Michael Burry has been buying in this video. And so looking at the holdings, you see it's a bunch of these one-off like weird names. And it's also, a couple $1 million positions. He has Geo, which is a prison company effectively, a couple $1 million purchase, and he increased it significantly, as a percentage of his portfolio. Previously, that was the only position in his portfolio. So this is a really important data point. In the second quarter, he effectively blew out of his portfolio, like 99% of his portfolio. So it's just one name, couple $1 million. Now, I love this time of year because I love seeing what everyone owns. It's a great time to try to figure out, hey, do they own something that I should look into? Like, does this smell good? Does this align with the values I have or the investment journey I want to take? How I want to sleep at night, and the type of companies that I feel excited to own, or excited to invest with. And so I love seeing these updates. Now, it is worth understanding that it's at a delay because the filings are as of, let's say in this case, it's September 30th, but you're just getting them now. So there is a little bit of a delay, but given that he is a value investor, it should have the core thesis. It should still hold. It's not going to dramatically change. It's not like he's this day trader. Now, he does have higher turnover than a lot of traditional value investors, but he does have long-term investment theses. So let's actually look at his portfolio. In this video, we're going to talk about the top 3 of his different positions as we go into it. So you can see his positions here: Geo, Curate, I believe this CoreCivic, Aerojet, Charter, and one of the Liberty Complex. Actually, 3 of the different companies he owns is part of a John Malone Liberty Complex, I believe. John Malone, if you check out a book called Cable Cowboys, he's one of the most successful cable investors of all times. I think he's also one of the largest landowners in the U.S., worth several $1 billion. And so 3 of these different investments, I believe, are part of the Liberty Complex. So what John Malone does is he goes, hey, I don't like paying taxes, so I'm going to load these companies up with lots of debt. And so the interest payment will hopefully cover, the amounts that of effectively free cash flow we have, so that way if we perfectly match it, then we don't actually have to pay taxes. So that's sort of the strategy that you've seen him employ historically, and that's part of the reason why he's had such a successful track record, John Malone, that is. And so it's interesting to see him make these bets. I, once again, like looking at Michael Burry because sometimes you do find something where you can make some money. For example, last year, maybe it was actually the year before, he called or he bought, McKesson, MCK, which caused me to go, oh, wait a second, I actually researched this previously. I should look into it. So I re-looked at it. I said, oh, snap, this is a beautiful industry. It's an oligopoly. It was trading at like 8-9 times free cash flow. So I called it out to my Unrivaled Investing subscribers. I made a video about it. I did a post. And I said, hey, and I ultimately bought it for myself. I made it one of my top positions personally, sort of saying, hey, Michael Burry bought it. Now I should research it myself. Just because Michael Burry bought it doesn't mean you should consider buying it. This is the important part with investing. You need to figure out what's right for your own journey. And you're going to see in this video that a lot of this stuff, I'm like, whatever. Maybe it's not right for me, but hopefully it works out for him. So, but with McKesson, I was like, okay, you got this healthcare company, not a lot of debt, pretty stable business. And, I think, the stock could go up dramatically. And since then, it's actually been one of the best performing stocks in the stock market since Michael Burry bought it now, where it's, went up about 75%. But once again, you need to have your own judgment. What I saw Michael Burry quickly traded out of it after a quarter or two. And I was like, I still think it's worth more. And so I actually held on for a bit longer and it appreciated. But I've subsequently trimmed most of that position just because they do have some customer concentration risk with McKesson. But I need to think about that some more, and I'll probably talk about it with my Unrivaled Investing subscribers. So let's talk about Michael Burry's top 3 holdings. So one is the Geo Group, GEO. So this is once again a prison business, so for-profit prisons. So they talk about leading diversified government service provider. I love sort of the PC ways that companies go around saying what they do without saying what they do. Like, yes, government service provider. Yes. Why don't you just say correctional facilities or prisons? We make sure the bad guys stay locked up. So they have secure facilities, processing centers, and community reentry centers in the United States, Australia, South Africa, and the United Kingdom. So they talk about having 102 facilities with 82,000 beds. Wow, this is a big complex, 82,000 beds. So, okay, so you have a very rough understanding of what do they do. When I looked at their financials, over 50% of their revenue came from the U.S. government, the federal government. So, okay, so you do have some customer concentration risk. So what are they talking about from the fourth quarter? They said fourth quarter, we're expecting net income of 30 to 32 million. Okay, so that's an important data point. That suggests generating around 120 million in profit. And then they're saying, hey, well, this guidance reflects the fact that we lost a contract. Okay, so that's an important data point to reflect on. So, okay, so the results might have been a little bit weaker because this non-renewal of a contract from the Federal Bureau of Prisons for an 1,800 bed in Michigan. Now, that's not immaterial, 1,800 out of 82,000, so it's pretty big. Now, what do you see what they're doing? They're reducing their debt maturing. So, okay, this is really interesting. They're saying, hey, we've reduced our debt that's maturing before 2026. So there really isn't any debt blow-up risks over the next few years from a maturity perspective, or debt might come due. So over the next few years, and when you have debt, there's really 2 different types of risks with debt. One is that your financial results decline, and then your lenders say, hey, your business isn't performing the way you've effectively committed, and so it breaches a covenant, a financial covenant, and then the lenders say, hey, you need to repay this right now. Another way you blow up with debt is the maturities, sort of saying, hey, this bond is due now. Do you have the cash for it? And a lot of businesses run very risky processes of sort of saying, hey, well, we're hoping we can refinance this debt. We're hoping the capital markets are working in the future, and, la-di-da. And what they're doing, I'd argue what you're seeing with Geo Group is very prudent, saying, hey, we are covering our debt, so that way there's nothing material maturing prior to 2026. The only thing material is $23 million, which relative to their income of $30 million per quarter is immaterial. And so they still have significant debt loads because this is unfortunately, prisons are very, very stable business. I say unfortunately just from a society perspective, that there's always a good amount of people in prison. And so, they do have a very sizable amount of debt of 3.5 times adjusted EBITDA. Now, looking at Geo stock around $9 per share, that implies around $1.1 billion market cap. So that means, okay, $1.1 billion market cap. In the fourth quarter, they're saying that they're going to do around 30 million in earnings. So that means overall for the year, maybe, I'm doing very rough penciling out to see if this might be interesting for you. So you're looking at one of the largest private, for-profit prison companies, 80,000 plus beds, primarily in the US. They'd have a lot of debt. Around 120 million in earnings that they're penciling out, $1.1 billion market cap, and versus 120 million in earnings, that should suggest that it's trading around 9 times earnings. So that is, kind of interesting. It's certainly cheap, so you could understand why Michael Burry owns it. Okay, so let's go into the next holding, which is Curate Retail. QRTEA is the ticker. So when you're looking at this business, this is the traditional QVC HSN business. So this is a bunch of ladies, typically older ladies, sitting around. They haven't really gotten as comfortable, let's say, doing e-commerce. So they watch the QVC network or a HSN TV show where you have these people saying, this blend is fantastic. You really need to consider buying it. It's a great deal. And then these moms go like, oh man, this is great. I'm not being like ridiculous here. Like, well, maybe a little bit, but like overall, the buyers, they have talked about it. It's like generally older white women. I don't know if they have these accents like I'm suggesting, but anyway, you get the picture. So they're buying these products because someone's showing it off like, oh, this blender is really great. And, oh, you're going to be making the best smoothies when you buy this blender. And so they show it, like on the TV show, and then people call in and buy it. And that's their legacy business with HSN and QVC. They've tried to move online a bit, but that's really the business right now. They talk about e-commerce revenue being 62% of revenue, but declining. So this is QRTEA, or Curate, is the business. You could see that the number of users, and this is the part that's concerning for the QVC HSN, that's the main part of their business, has been declining for the last few years. They did see a 2020 pickup where it got to 11.3 million customers, it looks like, but then it dropped to 11.1. Now it dropped to 9.3. So this is the aspect of like, okay, either customers are sort of maturing or expiring, or customers are just not interested, or they're finding better apps to shop with. I mean, this suggests they're actively losing market share. They will talk about, tougher e-commerce picture, which makes sense, but this does suggest structural problems, in my opinion, when you see this sizable drop. That does suggest real loss in market share. Now, looking at the business, it does look like it's going out of business. You look at the stock price, from looks like $10 over a year ago to now $2. So stock is absolutely crushed, around $900 million market cap. Once again, it looks like it's going out of business. And looking at the results, it's not hard to see why. You look at their free cash flow year to date, they've actually been cash burn, which is significant. They still have sizable amounts of debt. Now, if you maybe adjust the results and maybe, tweak it, maybe they can get back to 100 million or 200 million in profitability. They do have some unprofitable elements to their business like Zulily. So maybe you can, tweak the business and get profitable again and generate, if you can generate 100 to 200 million in free cash flow at $800 million valuation, and you're returning that cash flow, maybe it's super cheap. But I look at this and I'm thinking the debt, you're losing market share. It just, Michael Burry likes to buy, he's literally said this in the past, that he likes to buy things with an ick factor, like, ugh, I really don't want to own it. I personally, I'm not looking for the ick factor personally. And I get it. Like he's a better investor than I am, straight up. He's compounded much better than I am, but much faster and made a lot more money. But everyone needs to figure out what's right for their own journey. What they can stick with through a full market cycle. That's what I mean. Like if something's so icky that you're going to sell it in a moment of crisis, like that's not going to do you any good. Okay, so that's Curate. The next one is CXW, which is the largest private owner of real estate utilized by government agencies. Another very funny way of saying, hey, we are one of the largest for-profit prison companies, which once again probably fits, unfortunately, with Michael Burry's view of America and the direction America is heading in, unfortunately, that he's looking at for-profit prison companies, but overall very stable businesses. So why is he interested in CXW? Well, let's actually understand this picture a bit. So looking at it, it's penciling out, saying for the year around 100 million in net income, but then you have to add back non-cash expenses of around 100 million, which is kind of interesting. And make some tweaks for income tax. And so looking at it overall, they're saying their normalized funds from operations, which is a very rough proxy for free cash flow. They're saying it's around 150 million for CXW. Once again, one of the largest, prison companies in the US, for 150 million in free cash flow. This for a company that has, $1.3 billion market cap. I quickly checked this myself. I'm just posting the screenshot from Yahoo, but I double checked the math, and this is approximately right. And so once again, you're buying a business for 9 times free cash flow. So and he arguably, Michael Burry might have been buying it a bit cheaper, maybe 8 times, maybe 7 times. So you could see why he likes this. And then when you layer on a different, additional aspects like, hey, we were able to buy 5% of our shares outstanding and we're reducing our debt by $250 million a year. Now that part of that's from selling assets. And then they say, hey, we anticipate increased occupancy levels. So, we're expecting to return to growth once we have this sort of transitional, we had this correctional facility that's, transitioning to a new state contract award. So effectively, it sounds like a business that they lost. So they're saying, hey, once that transition is complete, which they expect to complete at the end of the year, they expect to get back to growth. So I don't want to, dive too deep in this whole, as we consider another prison company. But I wanted to, just cover a couple of different things so that way you could understand what's going on. I mean, looking at these holdings, broadly, there's Michael Burry's either, and keep in mind, this is why it's so important to understand 3 factors drive returns over time: valuation, fundamental growth, and cash flow to shareholders. And so Michael Burry always looks at these. He, in my opinion, is typically more biased to looking at that valuation one, where if he's like, hey, this is at 5 times free cash flow or 7 times free cash flow, then he typically starts buying, he gets excited. I personally want one that's a little bit more biased to the free cash flow plus valuation plus growth. I want all 3 of those. That's my goal, at least. So you could see why with something like CoreCivic or CXW, why that can benefit over time, because it is trading at that like 9 times normalized free cash flow figure. And they're saying, hey, we get back to growth. Okay, well, if you get back to growth for a very stable business like that, does this automatically re-rate to, let's say, 15 times, free cash flow? So you get that valuation expansion, you get that free cash flow returned to you as a shareholder. So this is another one of these stories where you could say, oh, I see how this works out for Michael Burry, and it can work out really well. So this is, it's an interesting one. Maybe it's worth digging more into. Okay, so what's the most important takeaway from looking at these filings and what Michael Burry's buying? What do I think is the most important? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. And so I think the most important takeaway that investors should consider, is if you're looking to think, trying to get in the headspace of Michael Burry, which is that previously his portfolio was over $2 billion. And he just cut it dramatically in 2021. So like he was on it. He called this downturn. He was on it, and he acted on it. And at least this is based on his U.S. holdings. Now what you're looking at is a portfolio with $45 million. So this is still pales in comparison to where they were. So that's a really important data point. Like he might be buying now, but it is so small scale, like $45 million versus $2 billion. It's still only like 4 or 5% of where he previously was. So unless he's buying a lot of international securities, which you can't see because this is for, SEC requirements of posting what you own, in the US, I look at this and I'm thinking, or US securities, I'm thinking the fundamental thesis and concern that he's called out about US equities is still playing out. Anyone that's sort of aggressively buying here is actually fighting the Fed. The Fed, even though inflation recently came in slightly better than folks expected, the Federal Reserve has made it very clear, Jerome Powell has made it very clear, higher rates for longer, monetary tightening for longer. And this goes into Michael Burry's concern, which is, hey, you've had historic overvaluation, you have historic froth, and the market's only down less than 20% from an all-time high created by record monetary stimulus and record fiscal stimulus. So I think he's looking at this. It wouldn't surprise me if he actually has huge shorts on in some way. And I'm thinking, I just don't think that this is the absolute bottom. I don't think, a couple of, private for-profit, a bunch of for-profit prison companies at 9 times free cash flow is really the bottom. I think, when you see, and I don't think that's the best deal you're going to get. I think in a true market bottom, you see these types of things sell off even more, potentially. I think that Curate thing is the type of thing that goes bankrupt in a market downturn. It's consumer discretionary, lots of debt, and they already are cash burn year to date, but who knows? I'm not, by no means am I super knowledgeable about this. Sort of just quick take on these top 3 of his portfolio holdings. But I think looking at this investment environment, still an 18, 19 times, earnings for the S&P 500 and the Federal Reserve still tightening, I don't think you've seen the bottom yet. And I think that's ultimately, what Michael Burry's banking on. And we'll see, ultimately with his own holdings in the future. Now it's important to do both top down, which is what I'm saying here. Like, hey, the Federal Reserve's still tightening. And I don't think you've had market bottoms before with the Federal Reserve still actively tightening. Unemployment's still only at 3.7%, folks. Like, if they're truly able to keep unemployment below 4% through this market cycle, I mean, that would just be mind blowing. Like, that would be incredible. I hope so, because no one wants to see unemployment go a lot higher, but that's just not likely. I think the effects of monetary tightening are just starting to be felt, and you're going to see it in the upcoming quarters with potentially economic earnings recession. So we'll see how that plays out. But I think, that's the top-down concern. Bottoms up, what are you seeing? I'm seeing S&P 500 at 18, 19 times earnings. That is not deep value. I'm occasionally seeing individual companies where it's like, oh, I called this out to my Unrivaled Investing subscribers earlier this month. I'm like, oh, here's this payments company, one of the largest payments companies in the world, trading at like 12 times free cash flow. Okay, so that's interesting, and I can understand why folks don't quite see it. Okay, that's interesting, but you still have just a lot of froth out there. You still have, ridiculous SPACs that still have multi-billion-dollar valuations, even that they're down, 70, 80%. It's like, this business doesn't have a business model. Like, what's still going on? So I look at that and I'm still thinking, like, the froth hasn't been completely wrung out yet. And we also haven't really seen that unfortunate downside to a market downside, which is, the real economic impact on society. So, and that's the point where you start seeing real capitulation with securities. So I'm looking at this and I'm thinking, top down, still haven't seen it. Bottom up, I'm still not seeing the crazy bargains. I do call out the things that I own to my subscribers at unrivaledinvesting.com. But I think that's the main takeaway from Michael Burry, which is, if his portfolio is predominantly US, he's still, his biggest bet is still effectively cash. So I hope you enjoyed this video. If so, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for watching.